Hi everybody, Mindy here. I know I usually do my videos about Forex and the Forex market, the Forex prices, Forex price action, but today I'm going to talk about something else. I'm going to talk about the stock market, okay? Because as you can see, all the headlines, oh my goodness, you think the sky is falling. Wall Street bloodbath, okay? The Dow went down today 800 points, right? And so they're saying, oh, one of the largest daily point drops on record as recession fears hit fever pitch. And it doesn't really matter what website you go to that has financial news. We can go to CNN, hop over to CNN. Worst day for stocks of 2019. Wow, it's so scary, right? They're saying that there's some signal that hasn't happened for over a decade that's just saying, you know, the bottom's going to fall out of the market. Everybody needs to panic. We can go to Bloomberg, see what they have to say. U.S. stocks tumble on economy as Dow falls the most in 2019, right? The worst sell-off ever. Even cryptocurrencies are getting clobbered in this market. You know, you just think that the sky is falling, right? But I think everybody needs to sit back, take a chill pill, and let me show you a few things about this market. Let's just go over here to Fox. Let's click on the big article, the main headline. Oh, the sky's falling, right? And let's just take a look at what they're saying. Okay, the Dow Jones Industrial Average went down 800 points today. Well, 800 points equals just over 3%. Okay? Now, that's a big drop for one day. There's no doubt about that. The NASDAQ went down 3% as well, just over 3%. The S&P went down 2.93, right at 3%. And oh my, oil went down about 3.6%. Okay? Yeah, that's a pretty big drop for one day. But let's just go through and take a look at what all they're saying. Well, here they give the Dow Jones Industrial Average, and they're giving you the last price of the day. The market just closed about a half an hour ago. They're telling you that it went down 800. Oh, big red number, 800 points. But that really is 3%. Okay, I'm not discounting that that's a big drop for one day. But the thing is, I think we need to take a look at the charts and see what's really going on here. Now, on this chart, what I'm showing you is this is the Dow Jones Industrial Average Index. Okay, so all of the numbers are proportionally the same, but on the actual numbers for the Dow, if they are reading 25,479 on this chart, that number would show up as 254.79. Okay, it's the same thing. It's just kind of divided down because this is an index and not the whole market. So same thing, same numbers, just smaller numbers so that people can get their arms around it and their minds around it more than anything else. But when we look at this chart, this is the daily chart, and currently I've only taken it back to about the 1st of June. But, all the hype today is that today's daily bar is, one of the longest in history, one of the top 4 daily drops. As far as a bar length goes, okay? So, but when we look at this bar and we look at the low for today, everybody is all panicking today. But what we see is that we were actually lower a week ago. And the bar from a week ago, even though it opened and closed closer together, the bar itself from the daily high and the daily low was actually a longer bar than what we have today. So all of the big hype today is because the bar opened at the high today, the high price for today, and it closed right at the low of the day, right? So everybody's in a big panic, right? But when you look at the length of the bar, okay, on this chart it's the range is 5.63. What we see is that the length of today's daily bar isn't that much different from yesterday's bar. Yesterday's bar was actually 5.94. Today's is 5.63. A week ago, we had a bar that was 6.33 in range. 2 days prior to that, we had a bar that was 7.36 in range. You can see that, over the last few weeks, we've had lots of bars, lots of daily bars that have been longer than today's bar. The big hype today is because the price opened at the daily high, closed at the daily low, and didn't bounce back during the day, right? But what should we expect to happen next? Well, the thing is, what you have to understand is that when you're looking at a chart and you're only taking it back to the 1st of June, it looks like, oh my, look how much we've lost. Look how much ground we've lost. But you have to keep this in perspective. So let's just shrink up this chart a little bit. And what we see is that if we go back to October of last year, if we go back to there, we were at highs that were not that far off from the highs that we've had in the last few weeks. And what did we have? We had a sell-off that actually went down to 216, okay? So in this move right here, coming down on this correction in the market, the price went from 269.50, let's just call it 269.50, to 217.13. So 269 minus 217, what is that, 52? At the equivalent of about 5,000 points on the Dow, right? And when we see what's happened today, it's really not that big of a deal. And what we need to expect is that, yeah, the stock market, the Dow, could fall more. But if we really want to know how far it should fall, we need to look at a bigger perspective. Okay? So let's just pull this chart out a little more. And what we see now is that if we take this chart back to November of 2016, which was almost 3 years ago, okay, we were down at 178, which was the equivalent of 17,860, right? And in the last 3 years, we've gone nothing but up, 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 up. And a couple of weeks ago, where was the stock market? Where was the Dow? It was at all-time highs, right? Now, what you have to understand about any financial market is that the price goes up and down while it's going up and while it's going down. That's just the nature of markets. They're going to make big moves and have corrections, and then make more moves and have corrections. Sometimes the corrections are deeper than other times, right? But when you've had 3 years of just almost straight upward action, with the exception of a couple of corrections along the way, you have to expect that the price is going to correct. Today's correction was about 3%, right, for just today. But what we can see is that we're actually down about 10% from the high, the highest high that we had a couple of weeks ago, right? Now, is this unusual? No, it's not. And when should we panic? Well, there is no reason to panic, because the thing about it is you have to expect corrections in markets. Now, if we wanted to take this chart back even farther, what I have to do here is I have to go give it more time. So instead of just doing 3 years, why don't we take this back? Oh, I don't know. I don't think 10 or 15 years would be too much, do you? Let's take it back 15 years. And just to make the chart easier to look at, instead of using daily bars, why don't we use weekly bars? Okay? So that will give us an even better perspective of what has happened. Now, even though I took it back 15 years, but everybody remembers 2008 and 2009 when we had the big dump, right? At that time, the stock market had never been higher than 14,000, right? And the stock market got up to 14,000 on this chart. That's going to show us 141. And we had the big dump, and the big dump went down to 64. That was literally a 50%, almost a 50% correction, right? So what you have to understand is that since that happened, and everybody thought the world was coming to an end at this time, but since that happened, look what the stock market has done. It has gone nowhere but up. I remember the day when people said that the Dow Jones would never break above 20,000 is what it would be, 200 on this chart. I remember the day when way back here, people said, well, how high can the stock market go? And even the most optimistic analysts out there said, oh, it's going to go to 20,000, but it'll never go above 20,000, right? Well, look at this. We made it to the 20,000 mark in 2012, in December of 2012. And since then, it's never looked back. Never. It's just gone straight up from there. So the thing is, if you really wanted to know how deep this correction could go, what we would have to do is we would have to literally go, okay, where was the high? And so let's just put a Fibonacci on this. And so here was the high, and where did that move come from? Well, it actually came from the low that happened in 2009, right? So if this is our Fibonacci sequence, what we see is that if we are really going to have a correction, a Fibonacci correction in this stock market, we could literally see the price come back down to 19,400, maybe as low as 16,900, and potentially as low as 14,498, right? Now, if it did that, what would that mean for the future? Well, what that would mean is that if it came down into this area, what that would be is that would literally be a normal occurrence in a financial instrument. And it would also project where the future prices could go. So on this chart, I can't even show it to you the way I have it set up. So let's just go in and change some settings here so that I can show you what that would mean for the future. Let's take this out about 100. So what that would mean for future is that if the price actually came down into this area and then the Fibonacci sequence continued, what that would mean is that in the future, the prices on the Dow could go up to 40,000, somewhere between 35,300 to potentially 40,300 and even higher, right? But the thing is, how long could that take? That could be months or years away, right? We could be talking about another 5 years, 10 years, who knows, before it got there, right? But if you want to know how deep this current correction could go, what you have to understand is that it could go down to between any of these 3 red lines. And if it did, that's not something to, panic over. That would be a normal movement in a financial market, because financial markets go up and they go down. And when they go up and they reach new highs, it's expected that the price is going to correct. It's just a matter of how much is it going to correct, right? So, and if it does correct, it doesn't mean the world's coming to an end. It just means that you're having a serious correction that is years overdue, because we have not had a Fibonacci correction in the Dow since 2009, okay? And that's 10 years, okay? For 10 years, the trajectory of this has been straight up, okay? Now, if we wanted to look at this a different way, what we could do is we could just go in and put a trend line on here. And for a trend line, if I was going to place a trend line the way I do it, I would start at the low, and then I would try to find at least 3 points that I could connect. Let's see where that might be. And if I was going to do a trend line, I would actually put it right in through here. Okay, because that's the first place that I can find where I can have 1, 2, 3 hits on that line. Okay, so another way of looking at this is that theoretically this price should correct down to the time when it meets this trend line. Now, if it did that tomorrow, the price would come down to 216, which would be 21,637 on the Dow, right? If it took 2 or 3 weeks for it to come down to this trend line, then the number's not going to be as dramatic, right? Now, if the price breaks below this trend line, then you have something to worry about, right? Because if the trend line currently is acting as support, if the price breaks below it, then the underside of the trend line starts acting as resistance, okay? And pushing the price further lower. But the thing is, when you're talking about the stock market, and you're talking about economies, and you're talking about companies, the thing is, this is just a correction, because the nature of stock and the nature of the stock market is to always have an upward trajectory, right? We would have to have something far more significant than a recession to make the stock market's trajectory literally start trending down permanently. There's almost nothing in the world that could make that happen outside of a nuclear war or a complete restructuring of the political system and the economic systems of all of the major countries, especially the United States. And that is not going to happen. Okay? It's not going to happen unless our total economy decides to turn completely upside down and inside out. If we were to go totally to a socialist system, the way that some of the Democratic presidential candidates want to do, yeah, in that situation where they're going to be trying to break apart every corporation in the country and restructure everything completely into a socialist system, that's something that could literally make the stock market start trending downward on a downward permanent trajectory. Okay, but other than that, as long as we have a capitalist system of government and we have corporations that their goal is to make money, right? That's their job. We might not like how they make money sometimes, and sometimes some companies are more ethical than other companies and things like that. But corporations are in business to make money, the same way you invest your money and you work for a living and things like that so that you can make money, right? So as long as the economy is growing, and even if it's not growing, even if we have a mild recession, our economic structure has not changed. So the stock market is not going to collapse. It might have a correction, but it's not going to get into a situation where it starts trending down and down and down and down and down forever instead of up. It's just a correction. Okay? So the thing is, I don't think anybody needs to panic. You do need to be aware that the corrective move that looks like it started to happen today may or may not continue, and you need to have an idea of how bad it could get if it continues, right? And so if you want the answer to that, that answer would be possibly somewhere in the range of 22,300, somewhere in that range. And if we have a full Fibonacci correction, the correction could take the Dow down to 19,400, possibly, and potentially as low as 14,500, somewhere in this range. Now, if the prices did come down that far, what would that mean? Well, what that would really mean is we would be right here in the range where we were trading on the Dow between October of 2014 and December of 2016. So what would that mean? That would mean that the stock market would essentially lose the value that it has accrued in the last 3 years, right? From 2016 to current. And honestly, that would not be out of the question. But what would happen after it retested this area? Then we would be on our way to complete the Fibonacci process that would eventually take the price on the Dow up to maybe as high as 40,000, which, that's not quite twice where we are right now, but close, close, close to twice as high as it is right now, right? Now, the thing is, nobody wants to take a hit on their stocks, right? But you have to understand corrections happen in the market. And that's why when I teach stock trading, which I haven't taught for a long time because my primary focus is on Forex now, but the thing is, these corrective moves are exactly why I don't think people should invest in stocks. I think they can trade stocks, but when you're trading stocks, you're not just buying them and holding them and hope the price is going to go up and up and up and up and up, continually, because stock prices don't do that. You can see that the stock prices go up and down all the time, right? Corrective move happens. So if you're going to be involved in the equities market, in the stock market, first of all, I suggest that you trade ETFs and inverse ETFs instead of individual stocks. That's going to help a lot. The key word in the sentence was trade. Not invest in, but trade. There's a difference. When you're investing in a stock or an ETF, you're buying it, you're waiting for the price to go up, and then you might sell it. But usually people who invest, they just hang on to it. They buy it, hold it, and expect that 10 years from now it's going to be worth much more than it was when they bought it. But if you want to make money in the stock market, you need to learn how to trade in the stock market, where you are buying low and selling high, right? And then on dips, you buy low, sell high, buy low, sell high, right? And you're actively participating. You're actively buying and selling your holdings, right? To maximize your profits. Because you can see out of the last, if we just take this chart back to a year, let's do that. We'll still keep it on the weekly chart, but let's just take this section of it. We'll just take, the last 2 years. How's that sound? There, we got about 2 years. Okay, now you can see that there were times when the price really didn't go up and down. It just kind of continued little tiny fluctuations, right? But and this is a weekly chart too, so but you can see that there are times when it would be appropriate to sell your stocks and buy them again, sell them again, buy them again, sell them again, right? Because when you're buying and selling, buying the dips, selling the spikes, you're going to make 2 or 3 times as much money as the person who just buys it here and holds it to there, right? So anyway, don't panic about this stock market situation today, but do know that, we might be seeing a corrective move. And if we do, you have to know where that corrective move could go. Now, I'm not saying it will go this low. It might not. It tried to make a corrective move, in December, right? And it only got down to here. It didn't make it even down to the trend line. It didn't make it, into the Fibonacci structure of what should have been the retracement, right? So it's tried several times to have corrective moves, but the economy's been so strong, the corrective moves haven't been that big, and they certainly haven't lasted very long. So, because if you remember, in December, everybody thought the world was falling apart then too. It didn't. But we did have a correction that took us from the most recent high at that time, which was 26,900, and the price came down to 21,600, right? And then what did it do? It bounced right back up into that area. Then we had another little correction, and a couple of weeks ago, where were we at? We were at all-time highs we'd never seen before in the stock market, right? So we're long overdue for a real Fibonacci retracement, right? A correction action that could literally come down into this area somewhere. So you have to be aware of that. But does that mean it's gonna do it this week or in the next couple of weeks? No. We might wait another 2 years before it makes this Fibonacci correction. We don't know. You never know with financial markets what the next day's going to bring. Okay? So, but there isn't a reason to panic. There certainly is not a reason for these headlines that are just panic-stricken. Turn on the fire alarms. Everybody has to panic. No, you don't have to panic. If you're a buy and hold person, you know what? You're going to take a temporary hit. But if you're a buy and hold person and you still have 8, 10, 15 years that you're planning on holding your stocks, don't worry about it. Because what's going to happen? After this corrective action, the stock market's going to be working its way up to here. Now, I'm not saying that's going to happen by Christmas. I'm saying that might take another 5, 10 years. Who knows? Who knows how long? Could happen, within 2 or 3 years, or it could happen in 18 years. You don't know. We never know. But the thing is, things always pan out to fit into some kind of a Fibonacci structure sooner or later, one way or the other. And if we're going to look at the Fibonacci structure from what we've had since the last time we had a significant correction, this is what we're looking at. And the thing is, we don't know yet if this is the high or not for the current high. We're just suspecting that it might be, right? But if the price doesn't come down to here before it goes higher, then this is not the high that we're looking for this corrective action that we expect might be forming. Okay? Now, if we wanted to look at this whole structure on a shorter term situation, what we can do is we can take that Fibonacci off. Let's go back to daily bars, and what we could do is we could say, okay, if we wanted to find a different Fibonacci structure, a shorter term Fibonacci structure, we could say, okay, here's the high that we've had so far, here's the low from where it came, from where the move came, and now where should the price come down to if this is in fact a Fibonacci structure? And it should still come down further than where we were today, and actually it should come somewhere between these 3 red lines. Okay, and as you can see, if we had a 100% retracement of the move from the most recent low to here, where are we going to come to? We're going to be coming to the trend line that I showed you earlier. This is the same trend line that we had on the weekly chart. So could that happen? It absolutely certainly could. Okay, but more than likely the price is going to stop somewhere in here and start bouncing again. And if it does, then the next bunch of highs that we should expect would be somewhere between 29,500 and 30,900 on the Dow, right? So we don't know what's going to happen. If we break this trend line, we're going down to where I showed you on the bigger time frame. Okay? So, and if we don't, we don't. But anyway, there you have it. Don't panic about the stock market. Just know that it's in a natural cycle, because all financial markets move up and down. They all have corrective moves. We're just in a corrective move. That's all there is to it. If you're a long-term trader and you're a buy and hold person in the stock market, don't worry about it. If you're a trader, then there's going to be a lot of wonderful buying opportunity. If you're a trader, you probably are already out of your holdings, which you should be. When it started dipping, you should have got out. Hold your money in cash. Wait for the big dives. Know where the big dives might come to, and take advantage of the buying opportunities. And it is that simple. Okay? So anyway, I just wanted to say that today, and I'll see y'all again soon. But don't forget, my main focus is Forex. So if you want to learn how to trade Forex instead of stocks, where you don't have to worry about all this stuff, then give me a call. Take a look at my website. Get in touch with me, and I'll teach you how to trade Forex, which is easier, safer, less confusing than stock trading. Okay? So I'll talk to you soon. Thanks for listening. Bye for now.